The housing market is already on shaky ground. Home prices are stuck, mortgage rates are high, and affordability, as many of you know, is a complete nightmare. But right now, there's a new wild card out there, and it's not only tariffs, but the idea of a recession. So, could new trade policies push inflation back up, keep mortgage rates higher for longer, and crush buyer demand? Or will it be a catalyst that finally forces the Fed to act? Josh, a lot of volatility out there in the market, a lot of going back and forth on mortgage rates, on the idea of a recession's coming. It's not. Let's talk about it.
Yeah, for anyone who's listened here for a period of time, you know that I am entering my 30th year of doing this. And what I can say is a long time. Bad news for me. But in 30 years, there is almost always some sort of trend in play. An uptrend, a downtrend, whether it's home prices, interest rates, and sometimes it's just sort of a sideways trend. We have not had the benefit for the last 6 months or so of a trend, although it is technically sideways. Sales volume down, sales prices up marginally, but kind of sideways. But what I would say is the hardest part about this is just conflicting narratives day by day. Data moves. We get data that goes one direction, data goes back the other direction. Today we got CPI. On the headline, the CPI looked great. It was a little bit lower than expected, 0.2% month over month versus 0.3%. So you're like, oh, that would be a positive for bonds. We bring interest rates down, improve affordability, give a small tailwind or a little impetus, a little kick in the pants to the housing market. And we've seen basically no reaction today. So you look inside of it. We talked about this last month. We had a hot CPI report. Market didn't like it for a day, but inside of there were some internals that carry over to PCE. We had a cool PPI, and it gave it back the rest of the month. And we started this nice little improvement that we've seen. So right now, interest rates, the bond market, both treasuries, mortgage-backed securities, has hit an interesting point where it wants some more evidence before it moves lower. Not giving up the gains we've had over the last weeks. But you said something probably 7 days ago. Said, "Hey, we need some consolidation here for a couple of weeks." That was a pretty quick move down in the late summer, early fall last year when rates dropped. We didn't get that consolidation. It just hammered all the way down, and we got a pretty strong reversal back up. So overall, this is healthy. But when you look back and say, "What is the why? What is going on?" The big one today, the big one in the last few weeks is tariffs. And not just are we going to get tariffs, because Trump has said this all the way through the election cycle. Once he was elected, we knew that they were going to come into play. We didn't know what they were going to look like, when they were going to come. The big issue, Jeb, is we still today, right now, have no idea what that means, because it changes and shifts day by day with how they're implemented, taken off, increased. So that uncertainty adds one more layer of complexity to trying to make decisions as a home buyer or homeowner, and trying to plan for a business who helps home buyers and homeowners.
Yeah, I think the general idea, or what most people need to understand, is it's going to take longer for interest rates to go down and stay down in a level that people want to see. That doesn't really speak to most people. So say below 6.5%. It's a lot easier for interest rates to go up, right? Because of the volatility in the market and everything that's out there. And so I think, some sideways movement, continuing to see the economy soften is what's going to allow that to happen. I mean, none of us want to see a recession. None of us want to see people losing their jobs, or, negative press every day, in mainstream media, basically talking about the economy slowing. But the reality is, if and when that happens, which it's likely going to, we've been on this upward trajectory for, hell, Josh, what's it been? 12 years, 13 years that we haven't had a real recession outside of the pandemic. That is what's going to cause the housing market to slow. But we often talk about, what drives markets. It's inventory, it's demand, and all of that is influenced by mortgage rates. So at the moment, we've seen inventory pick up, which again, part of it's seasonal. There are markets out there across the U.S. We've talked about them a lot: Florida, Texas, kind of the Southeast, that you're seeing more inventory than you are seeing in other areas across the U.S. But year over year, we're up about 28%. But still below the lows of last year. So inventory is increasing. There's price cuts out there, but we both know. I mean, we're putting an offer in on a property today where I'm representing the buyer on the real estate side. You're representing them on the mortgage side. And as of yesterday, there were 17 offers on the property. Today, we're another one. So we added at least 18. So I would imagine at this point, there's probably over 20 offers. So depending on where you are is going to dictate what kind of market you're seeing. So, but with that, let's kind of hammer down tariffs, hammer down the idea of a recession. How does that impact the housing market?
It's
outside of
conflicting.
Volatility.
Well, think about it. So it's conflicting, right? Because you say it slows the economy, and that when you're seeing GDP forecasts much lower, Atlanta Fed does their GDP now, but it's very volatile, especially early in a quarter. And we're looking at it, and it's showing really, really low numbers. But both Morgan Stanley and JP Morgan Chase came out yesterday saying 30 to 40% chance of a recession in the next 12 months. So about 1 in 3. It's a pretty solid chance, especially when we're going on. If you exclude the little blip recession at the beginning of COVID, we're going on 15, 17 years since the last recession. That's not normal. So we haven't had any hyper growth, but we also haven't had any of these corrections that we're overdue for.
Now, and I just want to jump in, Josh, because I we follow Logan Matashami, Housing Wire, and yesterday he posted something about a recession. That the idea that if a recession was looming in the next couple of months, you would see bonds a lot lower. You would see the 10-year a lot lower than where it currently is. And the reality is the market's not pricing in a recession as of right now because it's going to be front loaded by some of these other indicators that we haven't seen react at the moment. So if you're waiting for the recession to see lower rates, it may happen, but it may be 6, 12, 18 months from now. So that's not a real strategy when it comes to buying a home.
So let's talk again about the role of tariffs in that. We were probably overdue for a recession absent tariffs. Trump was talking earlier this week that, hey, we realize this is going to cause some short-term issues. I forget what his exact verbiage was, but they are aware that they are risking a slowdown in the economy, if not an outright recession, with this back and forth on these tariffs. There are some important issues that they're trying to negotiate, but to the average American, what do they care about? If you're looking at new construction, we've already seen lumber costs go up. They're saying, car prices could go up 20% just because of how much is using resources from Canada, labor from Mexico, even for domestic production. So if you're in the market for those things, those are important things. The Democrats have tried to hammer Trump on him saying in true Trump fashion, on day one, we're going to lower prices. No president could have delivered on that, but he set himself up by saying that. And Democrats are saying, well, he hasn't done that. Well, no duh. It's been 45 days, 50 days that they've been in office.
You just said no duh, Josh.
I did. No duh.
No duh.
That was my favorite.
I haven't heard that
since
since
my favorite phrase in fifth grade.
But
my parents probably wanted to slap that out of my mouth in fifth grade. But from that perspective, no one could have. And then when we want to talk about things like egg prices, hey, guess what? You know who doesn't control bird flu? The president. So like we're looking at things. What I ask you as someone listening to this show and trying to make decisions, ignore stupid people talking about things like egg prices when we have an issue that is impacted by something other than the overall outright economy. And someone tries to say, look, there's inflation because egg prices are high. We're going to want to watch auto prices. We're going to want to watch lumber. We're going to watch energy prices. We got the CPI data today. Even though it was good, it would have been even better were it not for the fact that energy prices, gas prices were down, but energy prices themselves were up. Well, we saw yesterday that a chunk of the country imports their electricity from Canada, and Canada is going to put a nice little tariff on that in return. So I'm smiling as I say that. It's not funny. It's truly not funny. It's called a trade war for a reason. We're not fighting with bombs, but we're fighting with numbers to try and achieve an outcome. And you and I and anyone listening to this may or may not agree with the outcomes they're pursuing, but it's absolutely happening. So to me, just the disruption and the disturbance in this, it's a headwind for an economy that didn't really need headwinds right now.
So, Josh, with that, at the moment, the Fed isn't. I mean, we're pricing in, I think, 2 to 3 rate cuts this year, with the idea that the Fed. I mean, depending on who you listen to in the Fed, there's not a rush to do anything. They want to see the data. They want to see what the economy's doing before making any real moves. How does that impact mortgage rates, how do mortgage rates impact the overall market in general, right? We've seen mortgage rates come down. We've seen buyer demand pick up. But to some degree, it hasn't dropped to a level where we've seen a huge influx of buyers. It's primarily benefiting those that are sitting on the sidelines. They're already ready to do something. Even if markets probably didn't move, there are buyers out there in the market. Some are a little bit more weary and want to see lower rates. But depending on who you follow, the idea is that interest rates around 5.8% is what starts the market moving. That's a rate that sellers are willing to put their homes on the market and potentially give up those 3 to 4% interest rates. And that's a rate where, demand also starts to pick up from new buyers and coming into the market. So we're about a full percent from there at the moment, depending on what you're looking at on, a mortgage rate basis. We've seen rates fluctuate between really 6.5% and 7%, right? Regardless, I mean, that's kind of the numbers on unconventional financing. How does all of that tie into what we're talking about here, Josh, in regards to moving housing, helping housing? Do tariffs play into this? Does inflation? What are we talking about?
You started by talking about the 3 Fed cuts that the futures market is pricing in right now, and I would argue that is what has been priced in to the mortgage rates right now. If we started the year at or just above 7%, and just to give you guys a context, I want to give you 2 real stories. Locked a loan last night, and then Jeb just talked about the offer going in today, and this is a real world example. The borrower last night. The price points are almost identical. Standard balance, conforming, conventional Fannie Freddie loan. The one last night, borrower putting 3% down with an 800 credit score, got 6.499, 0 points. The borrower today has a 730 credit score. It's not bad. It's a far cry from 800. They're putting 10% down, and they're going to be getting 6.875 with 0 points, or paying a point to get that. So roughly the cost is either I'm going to have 3/8 higher in interest rate, or I'm going to have to pay a point, in this $6,000 to get the same number. So we've talked many times on the show. The things you can control are your credit score. Maximize your credit score so you get the low end of that scale. But that's kind of within that range, Jeb, that you said of 6.5% to 7%. And from traveling from the start of the year in January, right at that 7% range, down to the best qualified borrowers are in the 6.5% right now, I think we've already priced that in. So for them to move lower, the futures market, the markets themselves, the bond market, traders in treasuries have to convince themselves that the economy is slowing, inflation is continuing to moderate, even if not as quickly as everyone would have liked. And if that happens, you'll see it in the futures market first, but then bonds and mortgages will follow. So we're at an important point here. We kind of been right at that 200-day moving average, bottom of the down channel that we've been looking at, and that down channel just continues to move lower. So if it gives way, you could see another 0.25% easily. And what I can tell you, Jeb, we ran through the list yesterday, about 130 people around the country on our refinance rate watch list. So the reality is the vast majority of those people bought in 2022 or later, after rates have gone up, and most of them are just out of the money right now, meaning that they need that 0.25% to 0.5% lower rates before it makes sense for them to pull the trigger. And that is an important threshold. It helps the economy in many, many ways. One of the reasons why the economy got so hot during COVID was those ultra low interest rates. People that bought with a 4.75 interest rate and refinanced to 3% and dropped their payment $400 or $500 a month. People get excited when they get a $2,000 tax return at the end of the year, tax refund at the end of the year, Jeb. Well, imagine getting $300, $400 a month. Well, we have a lot of buyers that are going to be getting $200, $300, $400 stimulus going forward if we get a little bit lower in rate. And recessions, remember, are, if not outright deflationary, they're disinflationary. You don't have a recession where you also have inflation lingering on. So kind of on that topic, it was another thing that you mentioned, Jeb. Trueflation can be very volatile, but it has a 97% correlation with CPI going forward. It's dropped a ton in the last 6 weeks, down to about 1.5, 1.45, somewhere in that range. So you're seeing forward-looking measures of GDP dropping precipitously, forward measures of inflation dropping precipitously. quickly. We saw in the CPI data today that the shelter inflation has caught up a lot on a month over month basis, but because it's an aggregate of the last 12 measures, it's still escalated or elevated relative to where housing inflation sits right now. And if we had 12 months caught up to today, we'd be about 1.9%. So don't be fooled by the headlines that you see that we've got sticky inflation, we're headed towards stagflation, inflation. I mean, first of all, inflation at 3% is unpleasant for all of us who are used to 30 to 40 years of 2% inflation. But 3% inflation is not exactly high historically, and it is moderating. It's just unevenly distributed throughout the measures of inflation.
Well, let's talk about something that I saw yesterday on social. A friend of mine posted a couple of different snaps, like screenshots of conversations with clients, two different clients on the same day, and the story was essentially the same. And it was one person had their house on the market, the other was a buyer, but they were both, hey, listen, I don't think the timing is right now. Too much happening in the economy. The fears of the stock market going down, everything kind of playing into that. It's a fear. And one was, hey, listen, I don't think it's the right time for me to sell my house and buy another. I want to remove my house from the market. And the other one was a buyer that was looking for another property, not the right time. What happens? Again, we don't know. This is in this. I'm not asking you to answer this directly, but it's a conversation because there's a fear out there. Right? Stock market, when the stock market tanks, that impacts how people perceive everything. Even though you don't need a stock, it impacts your net worth. In turn, people are using that money to help buy houses, so on and so forth. So do lower mortgage rates, what, I guess the question, Josh, is we're not likely to see the market of 2021, 2022 again. Lower rates stimulate some buyer activity, but probably not to a level where we see any sort of craziness. What are your thoughts on that?
I go back to price increases are dictated by supply-demand balance. So we know that there is pent-up demand out there, people that want to buy, but the affordability hasn't been there for them. So if rates come down, it will bring some of them into the market. You also know that there is pent-up supply. There are people who have needed a bigger house to move to a different city, to do something over the last few years, and they need rates lower to justify it. In terms of that wealth effect, some of the numbers say for every dollar of stock market wealth you add, it adds 2.8 cents of spending. So 2.8% of that gets spent into the economy every year. So that is also a positive for GDP and the economy. That comes out, but we've seen the numbers. Like 50% of spending, Jeb, is done by the top 10% of earners right now. Those folks are not our audience. They're not who we're selling homes to or financing homes to. People buying $3, $5, $10, $15 million homes often pay cash, or a large chunk of that is in cash. So it doesn't really impact us. So on the entry level, the two buyers we're talking about, one has probably $50,000 in savings and investments. The other has probably $125,000 in savings and investments. And both of them are putting a good chunk of that into the house. The house is their number one investment. They're savers. They're saving money. They have reserves, but they're not someone, to use an example, a friend of my wife, he was happy last year. His 401k hit $1 million. He's about 53 years old, hit $1 million. By the end of the year, it went to $1,250,000. So you're like, this is awesome. Well, that tends to tell you, I just made $250,000, or I have an additional $250,000 of savings, even though I don't make that in a year. Well, when the market turns around and that $1,250,000 drops 10%, you go, I just lost $125,000. That's more than I lost in a year. So you talk about it being important to not watch home prices, not watch the stock market on a day-to-day basis, and realize we need to look at this at like 3 to 5 year cycles. And you don't get to have 40, 50% gains over 2 years without giving some of that back. But it would be foolish to think that there's not going to be a break on the economy going forward, just like there was a little tailwind over the last few years from the stock market. And that is assuming that the stock market continues doing what it's doing. This is in a small correction at this point. If you get to a 20, 25% correction, it will impact behavior. But what I will say is that is less of an impact to my bread and butter consumer who is buying and financing $400,000 to $600,000 for their first home. So those people, are they impacted by it? Absolutely. rate, but are they impacted by it in the same way as the 50, 60-year-old who has a lifetime's worth of savings in the stock market? Not as much.
And I think if you're one of those people out there that have some fear at the moment, it's normal. Like you're not like, some anomaly in the market. I think it's normal to have some fear when looking at the direction of the economy and how that's going to impact your bottom line. And that's why we always talk about looking at real estate in, 5-10 year cycle, right? Look at the longer term, why it's important to hold on to real estate or anything for time. Is it you can get these adjustments in the market, and with time you're able to withstand those. Having some money in the bank, right? The two that Josh just talked about have reserves. They're not using every single dollar in order to buy a house. They're also comfortable with the payment. I can't speak for the other one, but the one that I'm helping can qualify for more home. They're choosing to go with a lesser purchase price because that's what they're comfortable with. That's the amount that they're comfortable with. They're not maxing out that, full pre-approval and saying, I'm going to the highest DTI I can to buy the biggest house I can. It's, hey, this is what we're comfortable with. And I think that's smart in this environment. So if you're out there and you're, persistent, you're, perseverance, you're ready to buy a home, now's the right time for you. Reach out, talk to Josh and the team here. We would love to help guide you through that process. We've helped hundreds of people here on YouTube, both purchase and refinance. So if you're in that world and you're looking to just push forward, there's a link in the description of the video. And also, if you're someone trying to refinance and you're looking for the right time, don't want to watch rates every day, let us do it. You can go to theeducatedhomebuyer.com/rate watch and get on that list and let Josh and his team watch rates for you. So, Josh, parting advice for somebody out there in the market right now that wants to become a home buyer, what are they focusing on?
We talk about buy when it's the right time in your life, and that's always the right advice. It's never more so the right advice than in the current market. I do believe that rates are going to trend down. Affordability is going to improve, but just like all those 125 people on that rate watch list, they bought with a payment they're comfortable with, and we're going to ride that down when the opportunity arises. And it will, even if it's not a permanent opportunity, there will be a temporary opportunity where you can drop that. So don't focus on where rates are today, assuming that you can afford, qualify, and are comfortable with where it is today. Don't worry about where home prices are going. From my perspective, you got to do your own research and get yourself to have your comfort level with that. I feel like Bill McBride over at Calculated Risk about 2 years ago, he wrote an article, seven years in purgatory. And he was saying, I expect 5 to 7 years of basically flat nominal home prices and negative real home prices, meaning after you account for inflation, he's expecting home price drops. Now we're 2.5 years into it, and we're about flat on both from that time frame. A little bit of nominal gains and level on real returns after you adjust for inflation. I expect that to be the case for the foreseeable future. So that means that if today's not the right day and you need to save some more money, you need to get your ducks in a row, you need to get your credit score from a 730 to an 800 so you get the absolute best interest rate, there's not a huge penalty for that. So long way of saying there's no FOMO, there's no pressure. The market's going to be fairly stable. There's going to be dips. There's going to be pops up in interest rates. So focus on you and buying when the time is right for you. So Jeb, that's from the buyer side. Do you have any additional thoughts for buyers or also advice for sellers?
No, I think you said, you nailed it. Talked to a client yesterday who, asked me, hey, how high can these townhomes go? Like how much higher can they go? And I said, I've been answering that same question for probably the last 10 to 15 years. How much higher can they go? And every year they go higher. And the people that don't buy are the people that continue to sit on the sidelines waiting for a pullback. And those that do reap the reward. Now, that's not a push to get you to go out there and do it, because there is a chance that home prices stagnate. They don't appreciate, 5+% a year, more of that nominal, flat, home price growth, 3-4%, something like that annually. But the reality is, if you're questioning that, if that's in your head, then you're probably not ready to buy a house. When it's the right time in your life, you start focusing on the other things. And at the end of the day, we talk about it all the time: monthly payment, money in the bank, longer term time horizon. So if that's you and you're ready to start the process, make sure you reach out to us. Drop us a comment. Let us know what you think is going to happen in the market. And if you haven't done so already, make sure you hit that like and subscribe. But until next time, adios.
Amigos.